Welcome to Wattle Partners update of the month of August. My guest, or actually my business partner, Drew Meredith. Welcome.
Good to be here as always.
How was the month of August?
It was exciting, personally and in financial markets, I think.
I was a little bit bored through the month of August.
We had a pretty hectic few weeks. There was the RAS Roadshow that we're going on at the moment.
Oh, yeah.
You
I went to
visited
Traralgon
which
and
was
found a new client and met some amazing people in Traralgon.
Did you get some good questions down there?
Yeah, interesting. Yep. And what about you? Where did you go?
Somehow I made the trade to go to Gold Coast and Brisbane for 22,
right.
23
I went
degree
to
weather,
Traralgon.
and you headed off to Traralgon. So
I'm a country boy at heart, so that makes sense.
Like probably met 300 or 400 people over 3 or 4 days. So
Yep.
It was fantastic. Asking plenty of questions around what people are worried about in portfolios, what value there is in financial advice, how do you build portfolios for retirement. So
Sure.
super exciting.
It's interesting how many clients we get now and new clients, and the questions coming from first-time users of financial planners,
Yeah.
and they're in their 60s.
Yeah.
So they've accumulated assets themselves through superannuation, got an inheritance, might have got a few other assets, and then they're starting to finally think about their financial future. I suppose that is because they don't have an income stream for the rest of their life. So they've got a finite level of capital, even if it's been collected in lots of different ways, and now they have to make that last. So.
Yeah, it's something that came out during the month was the intergenerational report, and this retirement issue was all over the papers. I'm sure everyone's seen it.
Sure.
Everywhere, and I think APRA, so the regulator of the industry super funds, came out, ASIC came out, and everyone's basically saying there's not enough work being done and not enough service or information on retirement. So we've talked about a lot, the whole financial system is set up to get people to invest, either default and be forced to invest, or just ride risk for an extended period of time. But when it gets to that finite pool of capital, there's not many resources, and there's no one able or willing to specialise in it. So
Yep. Well, we are.
Exactly. I mean,
We're the specialists.
outside of us.
Let's start with Qantas. What are your thoughts? Not a stock we've held for years. I think when I first joined this business in 1999, we held Qantas.
Not Virgin.
No, Virgin wasn't around. It would have been Ansett. That's how old I am. And it would have been about the same price, would you believe? Same price as NAB.
Yeah, it was a massive, you couldn't go past the paper without hearing something about Qantas. They've had the share price has done incredibly well for the last 2 or 3 years since the end of the pandemic. But they're in the news for all the wrong reasons. We don't want to be political, but there's kind of a broader market story there, which is like the power of a monopoly.
Yep.
They got in trouble for selling seats on cancelled flights.
Sure.
And massive increases in the cost of travel. We're heading over to the US for a financial advice conference, and that's
At the back of the plane.
yeah, incredibly expensive. way more than we thought. I think it's cheaper to go to Europe. So, but it just shows you, and it ended up with the CEO stepping down. So there's probably Alan Joyce to step down earlier than expected.
Yeah, I mean, you still have to question some of this executive remuneration of listed companies. ASIC is currently suing Qantas, and the CEO gets paid $10 million
On the way out the door.
shares. How is that in the best interest of shareholders? I have no idea.
Exactly. Some of it's a short-term incentive to get the share price higher, but what long-term impact does it have on business?
Yep. And Phil Lowe's finally moving on from the RBA.
Yeah, pass it on to Michelle Bullock. There was an article about handing the happy cup over the table.
Happy cup.
Yeah.
So she's going to cut rates now.
If Phil Lowe was happy.
Maybe not.
But I mean, you've seen rates were on hold. We're early-ish September. Rates were on hold again in September.
Sure.
And we've been talking about it for a while, that the peak of rates seems to have come.
Yep.
The only question I'm getting is about currency. So the Aussie dollar just continues to tank. Have you got any view on currency?
Yeah, it's the opposite to what the market's happening at the moment. So you would imagine that this story is mainly around the US rather than Australia. And for the people that have kind of first started to think about currency, it's really an interest rate margin game. So if you invested in a similar type of term deposit or bank deposit in the US, you're probably getting 1.5% greater than you're getting here. So therefore, if you're a European investor, you'd rather buy US dollars and invest your money in US term deposits or bonds versus investing in Australia. So there's more demand for currency in the US versus the demand for Australian currency. What do I think will happen in currency? I would be revert to mean. We think the mean's probably 72 cents over a long period of time. It's 63, 62 at the moment.
Yeah.
So I would still think that currency is going to go up. A more macro view would be, I think the US economy probably has to devalue their currency at some point. How do they do that? Maybe interest rates will have to fall in the US greater than they fall here.
Do you see a risk of the RBA increasing rates to fight the currency, or do you think that's well outside their thought process?
I think there's a whole heap of different ways the RBA could deal with currency than just pushing up rates.
And portfolio construction at the moment still generally unhedged, or
I think when like any decision that is made in a portfolio, you have to decide if it's if you have a framework to make that decision, or you have a policy. E.g., a policy could be always hedge your global exposure.
Yeah.
Or if you've got a framework, a bit more like our framework, we kind of believe that if you're under 2 standard deviations under the long-term mean of 72 cents, you'll go unhedged. You would hedge, and if you're 2 standard deviations above, you'll go unhedged. So probably around about now, you're thinking about heavily hedging your global exposure.
Yeah.
So that just means if you go into a fund and it's got 2 options, hedged and unhedged, you're probably selecting the hedged option versus the unhedged option.
And some of it we can do with the incremental dollar. So if we're going to put more money into global equities in the next 3 months, we'll look to put that into a hedged run rather than into more unhedged. And then the challenge you have building portfolios, and for superannuation it's generally fine, is that you get unrealised capital gains. So you sometimes you have to pay tax to switch that investment. A lot of our clients being in retirement are tax-free, so less of an issue. And then we had the Australian GDP and the US GDP results, which came out. And I mean, we're going to be a bit facetious in this episode, maybe, if that's the right word. And we've heard about recession for the last, how many? 9 months, 12 months, 18 months. Everyone's calling for a recession. Still not here. US employment data incredibly strong. Growth slowing. Both annualised growth in the US and Australia is both 2.1%. So I think maybe slightly below trend, but nothing overly significant. Is it? We overthink a recession?
Yeah, I think so. I mean, a recession sells papers, right?
Yeah.
So everyone will call a recession, and I've explained this to many clients, and we're worried about a recession, but if the economy was that big, a recession happens, a typical recession, the economy is that big. The economy is so big that a reduction, 2 negative quarters of 0.1 and 0.2 doesn't really change the economy as a whole. You're not going to feel that.
Yeah.
And the amount of times the economy is shrunk by, say, more than 5%, you could count them on, you wouldn't even need one hand. It's probably one or 2 times over the last 100 years. So.
Even COVID, it was a completely, after a massive shock event that created it, but then it bounced back basically in a very short period of time.
So we know that essentially the fundamental economy is very resilient, and probably these show how resilient we all are after rates have substantially changed. Some of the asset prices have changed, but the economy is still chugging along as it would.
And one of the biggest things we probably expected but took longer than most predicted was return of immigration to Australia. So we're seeing everyone's talking about a per capita recession again.
Yep.
That the economic growth is being driven by new people coming in rather than more economy for the same amount of people.
Sure.
And again, I think immigration, because of the lockdown, has essentially tripled what it would usually be.
Yep.
And you're seeing that unemployment rates continue to fall as well. So
wage growth, well, that'll have an effect in wage growth as well. So.
And China would probably be as usual. It doesn't seem to go off the headlines very often either. We're all worried about inflation in most of the world, and China had deflation, so prices fell for a quarter.
Sure, nicely controlled economy. Yeah. As investors, Australian investors, we love to hate China.
Yeah.
So we know very little about China really as an investment hub, but still a very powerful economy that is controlled. It probably provides some global stability more than instability.
Yeah, and they've started to cut rates over there to help stimulate the economy. We had some good data that came from Man GLG, one of the
Yep.
investments in our model portfolio, which talked about the fact that you wouldn't have the consumption that everywhere, the explosion in consumption that happened everywhere else in the world, that a lot of Chinese were actually putting money into investment or savings accounts to save, not to, save and then spend. And that's probably why you're seeing deflation, because they've got a massive savings rate compared to Australia, which has fallen from over 20% to under 8% at the moment. So it's clearly the drag. You've still got an economy growing at 4 to 5% every year, and the second biggest economy in the world.
Great. Any call outs from individual stocks over that period, or anything you want to comment on?
It was a negative month, but you can see long-term returns look pretty good. So in October, pretty much every global market was lower. Hong Kong and China the worst, down about 8%.
Yep.
Aussie All Ords, ASX 200 down 1.5%, but over 12 months to September, you're sitting at 9.7%, so nearly a 10% return.
Yep.
Over the 12 months. We had a big reporting season. So I got a couple of charts there. The theme was probably the problem with measuring anything on the ASX is that if two companies change, so BHP or CBA or CSL, if they do anything, the whole thing's skewed.
Yeah, sure.
So there's a fall in dividends of 2.5% compared to last year, and a 43% fall in profits. But I'd say a third of that fall is because BHP had a lower iron ore price, and it represents 12% of the index. Ramsay Healthcare was probably one of the difficult investments.
It was disappointing, wasn't it?
Yeah, but then Wesfarmers on the positive side was a standout.
Okay.
So
why diversity works, right?
yeah,
So,
and diverse within companies. So even Ramsay might have had a difficult period in Australia in terms of surgical admissions. They're getting good growth in the UK and France at the same time. Whereas Wesfarmers, Bunnings might be getting mature and growing at 3 or 4%, but they've got lithium mines. They've got Kmart. They're converting all their Target stores to Kmart stores and getting better growth there. And they bought the Priceline franchise at the same time. So they've got a diverse range of different cash flow and income streams, which is a question we got on the Rust Roadshow. What are the most important ratios when looking at a company for your portfolio?
Tell me, Drew, what are they?
Well, from my context, if we're buying a company in Australia for a retiree, we think two things are most important. One's cash flow. Is it going to provide me with dividends, or is the company actually doesn't have
yield?
cash flow? Free cash flow yield. So is there cash after all the expenses and interest and everything else is paid, or are they just building revenue but not converting it? And then return on invested capital. So Wesfarmers is a perfect example where the capital they're using is being put into companies that are growing and growing their own earnings. And that's just, you could just be boring and say it's about quality, but quality could be the most overused word.
I've never felt that there's a generational gap between you and I, but now I wouldn't use those two ratios. But
what are your preferred?
I'm old school. ROE, div yield.
Yeah, well, they're kind of the same, but
but they're a bit, bit
the old
fancy,
school version.
bit fancy.
I got the fancy ones.
Yeah, good luck measuring real, free cash flow.
Excellent.
So you pull that apart, do you, or you just get it? Where do you get that information from?
Multitude of sources. Plenty of research reports.
Great.
When you're looking at the ASX 100, that's sort of, as you know, this sort of stuff's freely available. But this is, it's a good point. This is why you have investment committees, because you can have differences of opinions, and we have plenty of those most of the time.
Well, that's why I like chairing them, because
good. I put the 12-month returns here, so the 12 months to September.
Yep.
And if you look there, so the ASX did 9.7. Our model of equal weighted did about 12% over the same period. And most clients looking at a return of 8% over the last 12 months to 31 August. So,
explain this concept that we use a lot, and maybe I know we normally do it at the end, beta for free. What does that mean? You keep saying it.
beta for free?
Yeah.
So the most simple definition of beta is what the market does.
Okay.
So the market being the ASX 200, when you pick up the paper or when you hear the news at night, the share market went up 20 points. And the market represents the largest companies listed on the Australian share market in Australia. Same thing. Weighted by the size of those companies.
Sure.
So BHP is a $200 billion company.
So if we're an index, that would be a lot bigger weighting than you.
Exactly.
Yeah.
So the market exposure, you can actually, by the market essentially is the average. You can get the average
Sure.
for free or close to free.
Okay, so if the market goes up 8, I can get that for free.
Pretty close to it.
And
So
I
there's
do
some
that.
options where you can buy something we've used before, which is called a Macquarie True Index
Oh, yeah?
investment, which guarantees on the balance sheet of Macquarie the index return. At worst, you can go to iShares or BlackRock, the biggest fund manager in the world, and buy the ASX 200, an ETF that holds all those underlying stocks, and they charge about, I'm going to get this wrong, like 0.06%.
So it's pretty free. It's
Close to
it's
free.
benefit.
You
close
pay
to
more
free.
for brokerage than you do for exposure to that investment. And basically you're saying for a portion of your portfolio, you can get the market for nothing.
Yeah.
And then from that, then you decide, do we think there's parts of the market or parts of the world that might do better than the market?
Yep.
And that's where you look for active management.
Yeah. So if you think about portfolio construction, where do you add the most value? It's always SAA, strategic asset allocation, tactical asset allocation, sector outlook, and sector weightings. And then the last component is the portfolio construction. Fund A, Fund B, index, etc. A lot of financial planners lead with the top.
Exactly, yeah.
So
I mean, I've probably got a good question for you is when a client calls and says they think they should sell everything, what's your answer?
sure. Well, why are they saying that?
I think at the moment I had a couple of these calls last week. At the moment, there's a lot of negative news, whether it's China, there's talk that the Chinese economy is going to impact on Australia and iron ore price is going to go down and tax is going to fall. There's a risk of recession in the US, oil prices are going crazy. I mean, every week you could bring up enough ideas.
Sure. I think that, anxiety and emotions around investment and psychology of investment is incredibly important. We work really hard with our clients onboarding and through the journey to try to understand why they're invested, and we've talked about that a bit today. A really simple objective is income plus growth. So the income people can physically see. If that's being daily, monthly, annually, it drops into a bank account, and growth you're trying to achieve over a 5-year period. It's essentially making sure with that finite pool of capital you have in retirement, do you have a strategy, and what does the strategy look like? At times, it does make sense to de-risk some of your portfolio, never all of your portfolio, and it does make sense at times to be aggressive with your portfolio selection. And that's called tactical asset allocation. We're quite active in that. I think this is the role that a financial planner plays, a good financial planner that never gets talked about. I don't know how many DIY investors that think they can do it themselves, but when you do it yourself, you also panic yourself, and they sell out at the wrong time, and then they feel guilty because they sold out at the wrong time and market goes up, and then they get nervous again, so they buy back into the market at the top and then it falls back down again. So I think managing money is a very hard thing to do yourself if you're truthful with yourself. It has showed over many generations that long-term investors into equity markets have done incredibly well. So you want to be a true long-term investor. You don't want to worry about today or tomorrow, and that takes a while. It took us a while through our journey to go one step back, and even though that we're probably creating a bit of noise by telling you what happened last month, it's really about, do you have your portfolio exposed to the right areas to give yourself the best opportunity to achieve what your stated long-term income and growth is.
And one of those golden rules is that big one is don't bet your house on the base case.
Yeah.
Which is part of what you're saying. That a lot of people, if you think you want to sell everything, you're basically saying that there's going to be some sort of capitulation in the global economy. And it could be the other one, which is you're worried about the surge of inflation, so you go into inflation-friendly assets like infrastructure and commodities historically. But our approach is always about balancing those risks and balancing the multiple outcomes, making sure that if one happens or doesn't happen, you're not worse off as a result. And
that's probably the hardest thing too, being a financial planner, is making sure that the client is exposed to the various assets they need to be exposed to achieve full diversification. Because most clients will go, I don't like gold. Why do I hold gold? Oh, I don't like that fund that went down. I don't want to hold a term deposit or a bond. I just want equities. And the problem with that is they're going to, even if their end destination ends up being the same, the journey is totally different. Yeah. And the journey ends up being very volatile and just adds to the emotional state. And the last thing I want to do when I'm retired at 80 I don't want to be worried about if my portfolio is going up or down 20 or 30%. I want to make sure that that ride is very, very smooth, and I understand where my portfolio is going. So you only achieve that through diversification, real diversification of assets.
And I've got a hypothetical question for you, or an
Sure.
experiential question.
Thanks.
Best investment of all time for you, and you can't say the businesses, or your education?
CSL.
Yeah.
CSL was a stock that when I first started,
Did you buy it?
I don't still have
Personal
it.
investment.
I don't know if I hold anything over that full period.
I've got one.
What have you got?
Trade Desk, which you might have held at some point as well.
Well, you had it like 3 years ago.
Still got it.
Yeah.
Still running. Not over the entire period, just your best investment you've ever had. That's like up 400%, I think.
It's a Trade Desk. Okay.
Does programmatic advertising. I got a nice joke about where my shirts come from because you're targeted on Instagram or Netflix.
Okay. I still can't answer you.
And that's wrapping up for the month.
Oh, you're wrapping. I thought
So
I
for
was
those
wrapping.
people who you get in this, we're probably going to be overseas at the time this goes live.
Yeah, Drew and I tomorrow are jumping on a plane going to as you all know, we're involved with wealth management conferences in Australia, and we've been to every wealth management conference. So we're going to a wealth management conference in the US called Future Proof. It's biggest of its kind. It's going to bring this fun element of learning. It's in California, so we're doing that for 3 or 4 days. And then we're going to the US, to New York, and we're meeting a whole host of new and interesting managers. And so I was saying, Drew, August was a little bit boring, but maybe next month we'll be able to come back with some really new ideas and some real insights. It's always good to get to some of these places and understand what's happening on the ground. So yeah, really keen for that.
Awesome.
Thanks, Drew.
Good to see you.
Thanks everyone for listening. We'll be back in 4 weeks with the update of September.